bags. Thanks for tuning into Accounting is a Joke. I'm Dr. Who, and it's always my humble pleasure to add some fun in the fundamentals of accounting. Finally, it's time for you to let go of those boring textbooks and fire those lame tutors as we chase the bags with this accounting information. Remember, gang, accounting ain't hard, it's really a joke. And I'm here to teach you the punchline. Bags. Okay, gang, we are going to mosey on over to the very last part of the adjusting process, which deals with unearned revenues. And so before we go into depth with the unearned revenues, I want to let you know that the unearned revenues are the exact opposite of the spectrum when dealing with a prepaid. So what do I mean about that? Well, under any circumstance that a prepaid expense is created, meaning that someone has paid for an expense in advance before it happens, the person that they actually paid that to has now created an unearned revenue. So anytime there's an unearned revenue being involved, the opposite perspective will be a prepaid, or anytime there's a prepaid expense involved, the opposite perspective will be an unearned. So let's get to it. First and foremost, those unearned revenues aren't revenues. I know that title could be misleading, but we have to identify the very first word, unearned. Remember, gang, revenues are providing a service or selling a product. And that's how we earn revenues. Whenever we earn revenues, we make the recordings as we earn them. How do you create an unearned revenue? An unearned revenue is created whenever the company receives cash in advance for a service to be provided in the future. So since that service hasn't been provided, that makes it unearned from the revenue perspective. So the company has cash right now, but owes the service. And so since the company owes the service, we know that a liability is created. Thus, unearned revenues are simply liabilities. And so what I want to do in this video is walk you through the process of initiating the unearned revenue and then making the adjustment at the end of the period. So without further ado, let's take it to the board. Okay, gang, we have yet another beautiful description of a proper way, should I say, to visualize how to approach unearned revenues. As an initial transaction, remember, unearned revenue isn't a revenue, it's a liability, and it occurs whenever you receive cash in advance, which means that we have to initiate the liability first on the books before we can make the adjustment. So there's an initial transaction as well as an adjustment. So when it comes in terms of the initial transaction, when a company actually receives the cash in advance, that unearned revenue or that liability is full, right? So whatever amount was given in advance for the service to be provided in the future, we record that full liability. Now, what about the revenue? At the time, initially, the revenue will not be recorded because it hasn't been earned. So your revenue doesn't exist, it's empty. But what happens as time goes on? As time goes on, the company actually provides the service, which thus earns the revenue. So as the company earns the revenue, revenues are going up, causing that actual liability in which the company owed to go down. So for the adjustment perspective, we will always decrease the liability because we've provided the service, thus increasing the revenue. So this is a beautiful example of, I call it a seesaw scale visualization of how you identify unearned revenues. Okay, gang, let's identify what's going on. This is May 1st, and as you should already know, we're going to treat this as the initial transaction. So on May 1st, suppose that It's a Joke received $12,000 in advance for 12 months rent from a client. So what are the key words? Receiving, right? Receive 12,000. Key words, in advance for 12 months rent from a client. So the fact that we receive cash in advance, obviously no cash is going up. So to initiate this transaction, we always have to debit cash. So we're going to debit cash for $12,000. But what else happened? We received cash in advance for a service that we haven't provided yet, which means we still owe for that service. Anytime we owe, we create a liability. And since liabilities belong in the clear game, we have to increase this liability by credit. So we're going to credit unearned, we're just going to call it rent revenue for $12,000. And so over here, I'm going to make a quick posting to the unearned rent revenue for $12,000. That's how much the liability is sitting on the ledger right now. Okay, as of May 1st. Now, time has passed and it's the end of the year and it's time for us to make our adjustments before we make our financial statements. So on December 31st, we're going to make the adjusted entry. We are adjusting the unearned rent revenue, which happens to be a liability, because as time has passed, what has happened, gang? We have been providing the service. We have been providing the rent to our client, whom paid us in advance. So as this time from May through December 31st, we've been giving them a service, so that liability must go down. So in order to adjust a liability to decrease a liability, we have to debit that. So what we're going to do is we're going to debit unearned rent revenue. Now, again, what is causing this liability to go down from the business perspective? We're providing a service. We're giving the rent for our client. And so since we're providing a service, we are thus earning rent revenue. And so we're going to increase that by crediting rent revenue. So we're halfway there, gang. And so now we have to calculate how much rent revenue the company has earned from May through December 31st. And if you've watched the previous video, you already know my tip where I say that you should probably want to use your fingers. Count the months on your hand. It's much easier. Gang, I still do it myself. Okay, I'm not ashamed.
You're a liar.
So if we count the months on our hand, that gives us 8 months of rent revenue we've provided a service for. So to properly calculate how much revenue that we've provided, we're going to take the total amount that was given in advance, which was $12,000. We're going to multiply it times the months that have passed, which is 8 that we've earned revenue. And we're going to divide that by the total amount of months of cash that was given in advance. And as you can see, gang, that has provided us with $8,000 of rent revenue that we've earned. So my follow-up question would be, how much unearned rent revenue do we have now as a balance? Well, if we take that posting from this adjustment entry of $8,000 on the debit side and post it to our T account in the ledger, we now see that our unearned rent revenue, which is a liability, has a balance of $4,000 left. So there's $4,000 left of a liability we have to provide a service to satisfy. And again, this is what makes adjustment entries so critical, because if we wouldn't have adjusted our unearned rent revenue, our liability still would have been on the books for $12,000, which means we'd have reported on the financial statement a liability that would have been overstated. And so with that being said, we have now adjusted it to the correct balance of $4,000. So there you have it, gang. A beautiful example of how to identify and approach unearned revenue. And again, I strongly suggest that you rewatch this video so that you can make sure you really understand how to address this issue. As always, gang, it's always my humble appreciation to have you guys with me as we chase the bags together. And if you are learning and that light bulb is clicking, don't forget to like, subscribe, or share the channel to your gang so that we all can chase the bag together. As always, gang, see you soon. Bags!